The multi-manager hedge fund's stellar performance in recent years has left their public investment peers in the dust. Is now a good time to jump aboard the multi-manager bandwagon? No one can deny the pod shops have done really well over the past few years. In a very, very turbulent market. We had a once-in-a-lifetime pandemic and lockdown. We had a war. We had all sorts of never-seen human consumption behavior, and as a result of all sorts of cyclical and secular trends that came out of COVID. And finally, the government monetary intervention globally that drove unpredictable market movement as a result. The multi-manager hedge fund platform, they're also called the pod shops because each portfolio manager is running their own pod as an autonomous strategy. The pod shops employ specialist traders who tend to focus on specific sector or a few sectors, and they spend millions building very complex centralized risk management systems that are used to monitor and manage these portfolio managers and their positions. There are only about 40 or so pod shops in the world, but they have an increasing impact on the overall stock market because they're attracting a disproportionate amount of investor interest. And because of the use of heavy leverage, their ownership of the stocks in the market is actually higher than the reported amount of assets they manage. What drove the rise of popularity of the pod shops? Volcker rules will be one, which came about after the global financial crisis in 2008 that eliminated prop strategies within big banks. For those of you who are too young to know, big banks, they used to be able to speculate the market using the bank's own capital, knowing if they blow up. For the commercial banks, they know they have the government bailout and the FDIC as the last resort. Second, the pod shop's promise of a return stream that should be immune to the overall market movements and therefore also lower volatility is very attractive to investors. Would anyone want to own a consistent return stream that's not impacted at all by whether the S&P 500 is up 10% or down 10% in a year? Hell yes, I'd be willing to pay for that if I'm invited. Finally, the regulatory hurdles and the startup costs are just rising years over year. For star analysts at established funds, increasingly they are going to the pod shops as an attractive next destination to get a first shot of running their own money without worrying about marketing and operating hassles, as the pod shops will take care of these functions in a centralized fashion. The multi-manager model has made a few of those founders some of the richest billionaires in the world, and their firm's success has enabled them to have a disproportionate brand recognition among many undergraduate campuses as they have the recruiting dollar to spend, and those shops provide one of the very few direct paths from the undergraduate into the world of public equity investing. Surviving in the pod shop model, however, is nothing from a smooth sailing. Pod shop PMs are treated no different from a single stock in a diversified portfolio of stocks, subject to various risk management parameters. Their portfolio is monitored by a centralized risk management team in real time. If a PM ventures into contractually agreed upon drawdown limits, that PM gets their allocated capital cut in half. And if that PM cannot get back into the green, that entire team working for that particular portfolio is let go. On the other hand, those who excel in the model gets more capital allocation and get compensated 15 to above 20% of the alpha they generate. So it's really as eat what you kill as you can get in the investment management world. It is the most meritocratic model, minimizing the amount of subjectivity involving compensation like in a single manager hedge fund or in a long only, but it's also brutally unforgiving and highest stress. The pod shops have had few years of very strong runs, especially in light of massive underperformance by their relative single manager and long-only peers. But even Ken Griffin himself acknowledged that if something's at its peak popularity, we're probably at a cyclical high. That's generally true for finance when things go through greed and fear. Now, there are a few headwinds facing the pod shops. First of all, when pod shops were putting up monster performance, the LPs didn't seem to mind. But as performance has normalized even for the pod shops, LPs are increasingly shying away from the pass-through expenses model of these firms. Unlike the 220 model of a single manager hedge fund, the pod shops literally pass all their operating costs to investors, and they can get away with it because they need to be resource intensive to generate alpha with a short-term focus and operating under heavy risk constraints. Second, pod shops rely on leverage to amplify their returns. Interest rate increase will make that more difficult, and LPs now expect higher return because now they have the alternative of allocating to returns that are higher and risk-free. Third, the pod shop's growth and the proportional reliance on leverage means the counterparties, such as the investment banks, are rethinking their exposure to the pod shops, which could stymie their growth. Finally, given the increasing ownership of the overall stock market by the pod shops, the regulators are pondering legislations to curb potential systemic risks posed by these levered firms to prevent another historical meltdown, such as what happened with LTCM leading up to the 2000s. The multi-managers are very labor intensive, and as a result, they have lower operating leverage than its investment management peers. Despite being only 8% of total hedge fund AUM, it accounts for 25% of the industry's headcount. Additionally, they need to invest heavily in technology, IT system, and alternative data to maintain their edge. Most importantly, they must possess PMs who can consistently create value under the market-neutral, risk-constrained investment style. And unfortunately, there are only a limited number of talents in the world who can do that consistently. This dynamic conforms to the power law Pareto principle concept. The biggest pod shops, namely Citadel, Millennium, and Balyasny, have recognized this power law reality, and they have closed to new allocations to maintain their competitive edge. And the incumbents, as a result, can maintain a massive barrier to entry by hoarding all the star PMs within the industry. Even a notable startup like Exodus Point, coming out of Millennium, has really failed to put up great numbers because they are likely suffering from adverse selection of having to settle for PMs who either have bounced around the Big Four or senior analysts under PMs at the Big Four who want their first shot at managing money but lack the experience. As a result, recently there has been a full-on talent war across the pod shops, with sign-on packages of $10 to $15 million and additional tens of millions of guarantees and payment for foregone bonuses from their prior shops to poach from competitors. Just recently, Bobby Jane, previously the right-hand man for Izzy Englander at Millennium, is striking out on his own with the goal to start his own multi-manager with a whopping $10 billion at launch. Rumors are already swirling that big numbers are being thrown at PMs from the incumbents to join his new venture. And he has already reportedly hired some big hitters at the senior level prior to its 2024 launch, just confirming the capital intensity of the pod shop business model. With these big numbers thrown around, both non-pod shop investment management firms and the sell side, such as the investment banks, are recognizing their inability to compete for top talent. I definitely see on finance forums the rising amount of young guns who want a direct shot at quote-unquote investing without going through the traditional 2-year investment banking program. The pod shops recognize the limited talent pool and have been proactive in building their internal pipeline from analysts to portfolio managers. The most successful effort has been the Point72 Academy. And with more capital than they can handle, the pod shops are also increasingly acting as a fund of fund and funneling client money into external fund managers. As the overall pod shop industry grows in assets, more PMs will likely crowd in the same trades, which makes it more difficult to generate alpha going forward. So at this juncture, we are likely observing peak pod shop era that will likely mean revert in the years to come. For aspiring young investors, pod shops provide the most amount of shots on goal to get a job in investment management, because this profession is notorious for having low turnover and high prerequisite. The direct path from undergraduate to professional investing is also super attractive. I cannot think of anything more tragic than people pursuing investment banking for the sole reason of its training and its exit opportunity, while they have to suffer under so much inefficiency, poor lifestyle, and culture. So to the extent one can get trained about the stock market and the technical skills at a real investment shop, I think even pursuing that is better than doing investment banking when you have zero interest in ever becoming a career deal maker. The same reasoning holds for going directly to the pod shop versus sell-side equity research. But I think you know the negatives about the pod shop as well as I do. I just want to caution you to really know what you are signing up for. There is no right or wrong way to invest, only that it needs to work for you and you eventually need to be able to perform under that specific model. Yes, pod shops can definitely make you get rich more quickly than other investment stocks, holding everything else constant, but only if you're good at it. So a few years of high pay is worse than a career of decent pay for better lifestyle and career stability. That's all I have on this matter. Please comment in the video description to let me know what you think. Now, if you want to hear more of my take on the investment management industry or other industries, I have 2 great videos for you in the upcoming screen. Make sure you check those out. If you found this helpful, please give it a like and subscribe to my channel for future contents on equity research, business analysis, and career advice. With that, I'll talk to you next time. Peace.